Hello and welcome to the Red Flag Alert channel. Today's video is on public limited companies, PLCs, versus private limited companies, LTDs. This topic lies in the analysis section of our website, so if you want to check out any more resources we have or any similar topics, I'll put a link in the description. So, a public limited company, PLC, is an organisation that is owned by shareholders and managed by directors. Members of the public can purchase stock and most pay out dividends once or twice a year. A private limited company, LTD, does not publicly trade shares and is limited to a maximum of 50 shareholders. They are a private entity that owns all liabilities, profits, and assets. So, in a bit more detail, what is a public limited company? A public limited company is a business that is managed by directors and owned by shareholders. Shares in this type of company can be freely sold and traded amongst the public. Unlike other structures such as partnerships and sole traders, a public limited company exists separate from its owners. This protects public limited companies from liabilities and debt. Shareholders cannot be held responsible for any business losses more than the amount they paid for their shares. Now, there are lots of pros and cons to public limited companies, but here are the top 6. So, pros. Anyone can invest their money into the company through shares, and the amount raised is typically much larger than in a private limited company. Founders are often able to leave the business with a comfortable exit strategy due to high transferability of shares. Visibility and well-known PLCs also increase the bid interest. These companies also have better brand recognition due to public shares on the stock exchange. This increases sales and makes the business more visible to valuable potential business partners. Cons include they must start with at least 50,000 of nominal share capital, with 12,500 minimum paid and committed to the business. Initial costs significantly higher than a private limited company. Additional and stricter legal and regulatory requirements, such as they need a trading certificate from Companies House before they can trade, and they must follow the rules of the London Stock Exchange. These companies are also more vulnerable to hostile takeover if most shareholders agree to bid. A potential bidder can build up a shareholding in advance of launching a bid attempt. Some additional things to consider is short-termism. People wanting a return on investment in shares means directors may focus on short-term results to increase profits rather than long-term. Aside from this, although being transparent increases brand recognition, it leaves the company exposed to more scrutiny by analysts and media commentary. What is a private limited company? A private limited company is the most common form of UK company incorporation. The difference from a public limited company is that they operate as a distinct legal entity to its director and shareholders. Essentially, it has profits, liabilities, and business assets, all belonging to the company itself. Again, there are the pros and cons of private limited companies. Pros can include owners can retain control as there are only a few shareholders, and often these shareholders are supportive friends and family. Profits are only shared between them and are received as a dividend. They're able to raise money through the issue of ordinary shares and by borrowing. And they have limited liability, which investors are protected by in the event the company fails. Cons, they must be registered with the Registrar of Companies. They have high setup costs, including legal and administrative. UK private limited companies must use documents called memorandums of association and articles of association. They're harder to motivate and control workers as profits are only shared with the shareholders and new workers will not hold shares. So, as a complete summary of everything said, here are the main differences between private and public limited companies. Public limited companies can offer their shares for sale to the public, and they must appoint a company secretary who is suitably qualified and cannot purchase their own shares out of capital. UK private limited companies only need 1 director, whereas public limited companies require 2. Private limited companies have 9 months to file their annual accounts, whereas public limited companies only have 6. Public limited companies are required to hold an annual general meeting, and this is not a requirement for private companies. Now, that's the end of our topic for today. If you want to learn more about public and private limited companies, you can check out our full article, which I've put in the description. Now, Here's a bit about Red Flag Alert. As the UK's only independent credit referencing agency, CRA, Red Flag Alert stays ahead of the competition with a multitude of tools and the freshest data. With monitoring alerts and over 100,000 updates to our platform per day, you can be assured you'll have the freshest data instantly. Our users benefit from data gathered from a wide range of reliable sources, data collected more often, our AI algorithm, which uses decades of insolvency data to predict each company's financial health accurately, our database, which is updated in real time, daily CRM updates, and real-time monitoring tools that can alert you as soon as one of your clients becomes a financial health risk. If you fancy reaching out to us or starting a 7-day free trial to see how we can benefit you, you can check out our website, redflagalert.com. You can call us on 0330 460 9877 or email us on sales@redflagalert.com. Thanks for watching.